Do you hate the thought of working past 55 or 60? Do you hate not being able to live the life you deserve today? Do you hate not knowing what your financial future looks like? It's time to stop doing what you hate. Here's your host, Mr. Harold Green.
Aloha, everyone. This is Harold Green of Bright Tree Financial Group, and it is time to stop doing what you hate. I hope you are having a fantastic day today. I know I am. And with me today, I have a special guest. But before I introduce him, I want to talk to you folks a little bit about my mission. And again, we've revamped our mission, and basically we want to help out the middle class, the upper middle class, anyone who's considered in the middle class, to get from where they are today to where they really want to be, and also to avoid the downfalls and the pitfalls and things that can erode and eat away their wealth. And so with that being said, I'd like to welcome to the show, Mr. Stuart Cruz. How are you, Stuart?
I'm doing great, Harold. Thanks. How are you doing?
I'm doing pretty good. Can you tell our listeners where you're located?
I'm in downtown Chicago. So it's snowing outside right now. A little bit different environment than where you're at, I suspect.
Yeah, we have our own version of snow. It's liquid snow. We don't get the white stuff. We get the other kind of stuff, the cold stuff. But it's all good. And Stuart, I want you to highlight for me the mission that you're on to help your clients. What is it that you're setting out to do for them? And I just wanted to give my listeners a sneak preview of who you are, where you are, what you do. And if anybody's listening to the show up there in the Chicago area, maybe they want to check you out. So talk to me a little bit.
You know, I really think this past year, and I've been in business a while, my mission kind of congealed to the very simple phrase of be better. So when I started off this financial advisory firm, my goal was to be better than the average client, the average advisor, be better than Wall Street. We have the people that work here have philosophies of trying to be better every day. So that's every single decision we make is viewed through that lens of how can we be better for our clients? How can we be better ourselves? How can we be better as a firm? And how can we continue to advance?
Awesome. Talk to me a little bit about your average client. What do they look like?
I have a pretty big spectrum, but my average client, it has money where it would seem like they wouldn't have to worry about their money. So usually a few $1 million, but they're retired. And if you are retired, back in the old day, when you retired at 65, you would live another 5 years and you couldn't outlive your money. But now you might live another 35 years and you could very easily outlive your money. If you're spending a few $100,000, you have inflation at 6-7% right now. You're not careful. You have a market downturn. At some point, you are going to lose in a 30-year period. If you're fully invested in the stock market, you're probably going to lose 30 or 40% several times along the way. So my average client is usually a millionaire, but on the edge of not being sure whether they can make it through their entire life without having to go back to work or making cuts or having problems.
Got it. And Stuart, I want to talk to the clients about the pitfalls and some of the things that are just really hurting the middle class right now, whether you be middle class, upper middle class, lower middle class. I want to talk about the people that are still working, not necessarily the ones that are retired. But give me like one or two or maybe even three things that you see that really hurt them the most. Like when they come in and they meet with you, like what do you see that's eroding their finances the fastest?
Often, and we haven't had to deal with this for honestly decades, is inflation is a big killer. So you might think, hey, I could get by on whatever that number is, $100,000 a year. And then the next year, if the cost of goods are inflating by 7%, you need $107,000. And the following year, you need $115,000. Not very much longer. You're looking at $200,000, $250,000, and no longer can that portfolio support you. It's one thing when inflation is at 1% and it does really erode into your purchasing power. It's another thing when you have some persistent inflation like it looks like we have right now. Now, hopefully the Fed is doing, and I believe they're doing everything that they can to reduce that, even if we have some short-term pain. Another thing that I find, and again, I mostly work in investment management. So what I find is if you have do-it-yourselfers, the research says that they tend to underperform long-term inflation. So they usually return 1-2%. So they're actually, even though they're They're trying to invest well for themselves. They're eating into their own purchasing power. This is usually as a result of, which is famous, a lot of biases that people have. And some of those biases are that they get focused or a little myopic on one area of the economy, like tech stocks, right? Tech stocks have done great and they're going to keep doing great. And while the companies themselves are changing the face of the economy, and that's phenomenal, and I wholeheartedly support that, they don't always make the best investment. So by way of example, Apple stock, the perennial favorite, I've made multiple videos on this, in that Apple is a phenomenal company and in fact dented the universe. But if you have a particular valuation that it's traded at for 10 years and that valuation has tripled when the growth of the company didn't triple or nothing changed about the company's trajectory at all, then you have to sit back and say, maybe we're overvalued and this isn't the best investment. Maybe we shouldn't just keep buying this stock. And that's what I find do-it-yourselfers do a lot of, is they just get very myopic and focused on one particular area and don't understand that when the dynamics have changed, that they need to shift gears.
So it's more passive management. I mean, correct me if I'm wrong, but the average investor is more of a buy and hold type of person, right? And isn't that what's preached a lot? Like buy and hold and don't try to chase?
Yeah, it is exactly what's preached. And that is generally what you see in 401ks and retirement accounts. But when I find that people manage their own account, they manage their own account according to the headline companies that they see. They're what I call the rock star companies. It used to be like back in the dot-com days, it was all the old school names, the Ciscos of the world. And then it became the Facebooks, and even Starbucks was one of those, and Tesla and Apple. And while, again, those companies are phenomenal companies and make incredible products and make you feel awesome as a consumer, they are not always idyllic as an investor. And so while you might buy and hold, a lot of times they're buying and holding in one particular asset class, and they're not diversified at all. So the vast majority of the portfolios that we see, both do-it-yourselfers and even by professionals, and I'll tell you why I think that is in a second, is it's like 85 to 95% domestic stocks and maybe some bonds. And that is diversification in one asset class, large cap stocks. But it's not diversification in the true sense of you're supposed to be buying investments that are not correlated or don't move together. So you have bonds in your portfolio because they don't move with stocks. You have real estate because they don't move with stocks and bonds. You have other asset classes that don't move together. So if you're buying primarily technology, they move 85% together. And so you might be diversified in one sector or one small segment, but overlooking 90% of the market and the diversification benefits there.
So why do you think people get so myopic in their approach? Is it just because, they don't know any better, or, they feel good about what they're doing, or they just have certain people that they want to believe and like hang on every word? I mean, like what is it like? And we're talking primarily about the middle class here. And the middle class is very educated. We have a lot of educated people that do well financially. But then I've seen some super smart people make some decisions that are real head scratchers. Talk to me about that.
There's two forces at play there. And so to step back, we are a quantitative house. So all of our decisions that we make are based and built in math and statistics. So our algorithms go out and look at the entire investable universe. So the computers don't have any biases. Right? They don't care that I owned Tesla at a particular spot in time, or Apple or what have you. They're looking at relative valuations across the board in different economies, and they're not subject to their own recency bias, right?
Yep.
So people in general across the globe have something called a familiarity bias. So the more you're used to seeing something, the more familiar it feels, the more you like it. Which is why a lot of times ad people have to make 10, 12, 15 impressions before you actually buy something, because you become more and more familiar with that particular item, and then you like it more, even though you have no experience with it. And so by way of example, it's one thing to be sitting in the United States and say, hey, 85% of your portfolio is comprised of domestic stocks. And we could argue that the United States is the best, most robust market in the globe. And you could be right. That could be a great argument for that. That said, if I were to go to Canada or Italy or some other country, their portfolios would also be comprised of about 85% of domestic stocks. So from where I sit, if I'm looking at that Italian investor and he's got Fiat and Alitalia and all these Italian companies, I'm like, oh my God, you are completely concentrated in your risk with just, Italian stocks. But that's because that's what they're familiar with.
Right.
That's what they see every day. And it would be different if you said, hey, around the globe, maybe in Italy, there was only 60% Italian-based stocks, and that there was some, more allocation to the U.S. And then you could say, hey, well, maybe that's because the U.S. is a bigger, brighter, robust market. But you see a very consistent, concentrated allocation across the globe to your domestic country. So that would indicate that it's not the U.S. is so great. It's that the bias is what's in place across the country, and we're just human beings, right?
My God. So how do you get your clients not to focus on any of that? Say, for example, they open up their portfolio, and on the platforms I use, clients can clearly see their positions. I know in some platforms you can choose not to allow your clients to see what your particular model is holding. But when they look in there and they see particular stocks, and they call you up and they say, Stuart, why are you holding this company? I don't like these guys. I don't like them. Get them out of here. Talk to me, like, how do you shield them from, making mistakes in their portfolios that they probably shouldn't make?
Yeah, it's like you're feeding into that second part. I said, I'll tell you why the portfolio managers also do this. And I think it's just because of that very thing. Okay. They do not want to take the time to educate their clients. And quite honestly, it's a headache, and it's almost a no-win proposition for the advisor if he goes against what the client wants or thinks is a good idea, right? So if the client does exactly what you said, and I'll give you an example. I could have a boatload of very familiar high-end companies that everybody knows. And if Apple drops in price, I am never going to be fired as a portfolio manager for having Apple go down in price because it's Apple. Nobody's ever going to fire me because I held Apple and it dropped, right? Yes. That is, how can you blame me for Apple losing value? Like, that's an amazing company. It's doing all the right things. Now, Again, I've shot tremendous number of webinars saying it's overvalued. You need to step out of Apple. But conversely, if I were to buy, I'm just going to go with an ETF, let's say a country ETF in Thailand.
Right.
I don't know anything about, or Turkey. Let's even go with Turkey, because that's maybe even has a slight negative connotation to it right now with the political environment.
Right.
And my clients are like, why would you buy anything in Turkey? What do you know about them? Do you know, like, it doesn't make any sense to me. And if that ETF went down, oh my God,
now you're going to get shot.
I could be fired.
Right.
When in fact, buying a country ETF, and where the valuations and the numbers and the technicals and the momentum and the relative strength are all on Turkey's side, and they're all against Apple right now, it would be a much better buy. And in fact, we have Turkey ETFs in our client's portfolio right now, and we're selling Apple right now. So we're going against the grain. So how do we get there? Is we just take a philosophical stand, because we are fiduciaries, that we have to invest in our client's portfolio in what we feel is in their best interest. And we take great pains to basically impart our education on them, try to educate the clients on why we're doing these things. What's the math behind it? What's the statistical reason behind it? And sometimes at the end of the day, the reason why they hire us is because they trust us, and they have acknowledged that maybe it is not in their best interest for them to manage their money, because this is what we do full time, and have the educational background and the experience, and have lived through multiple downturns over the course of multiple decades. So maybe we're a little bit better suited to do this than they are themselves. But we definitely have had that conversation many, many times.
Yeah, it's because when we say we're fiduciaries and we're doing what we believe is in your absolute best interest, that's like the I hate to say this, but it's kind of like the politician saying, "Hey, I'll vote, you vote for me, and then I'll fix your roads, I'll do this and I'll do that."
Yeah.
How do we, as fiduciaries, how do we make sure that we're doing what's in our clients' absolute best interest? Because they can go talk to their neighbor, Jim, or, Jerry or Susan, and then they say, well, my advisor said we should be doing this, and my advisor is doing that. Are you sure he knows what he's doing here? Like, how do you deal with that? Because here are some of the things that attack the middle class. We have a little time on our hands. We got a little money. We go to parties. We do our get-togethers. We have our country clubs, and then we talk to each other. And so how do you make sure that they're not being, hoodwinked or ambushed or like whatever you call it? Because, you can't stop your clients from talking to who they want to talk to.
I guess that's the age-old question, because you don't know what's being said behind the scenes. But at the end of the day, if they are talking about me and our portfolio, that's better than them not talking about it, right? So that's really great. I will say I've definitely had clients compare our portfolio and what we're doing to some very famous advertisement brands out there, and like, what, my neighbor has these guys, right, and they're up X%, and what are you doing? And I think in a world of investing, you're always going to be second guessed, right? I just think that's the nature of the course, right? I don't know that it's in my best interest to try and protect the clients. All I think I can do is educate them in what we're doing. And what I've always said was, I am 100% happy to compare my portfolio and my philosophy and my strategy to anybody else's out there. And if you want to bring your CPA in, your cousin Bob, your lawyer, and whomever you want in the meet, your buddy that lives across the street in your neighborhood, and we want to have a meeting and discuss why we're doing this. When you see our process and our philosophy and our systematic quantitative strategies, I will bet that other competitor, if you will, does not have that same process in place. Now, can I guarantee that the two neighbors talking are going to be talking at that level? No, and I don't think that's going to happen.
Exactly.
Right. But what I would hope would happen is that my clients would have so much trust in me that our philosophies and processes have done well over the years, or that are based in some sort of fundamental statistical financial reasoning, as opposed to, hey, I just feel like buying XYZ stock today because I hear they're coming out with a new product, or I'm going to put you in a list of 10 mutual funds because they're all in house. Like, that doesn't seem as involved as a process. And so we're happy to educate as much as possible. And we pull back the curtain. Like, it's not a black box that we're looking at. Right. If you say, why did you buy that Turkey ETF? Happy to tell you why. Happy to show you the math behind it. Happy to show you our research. Happy to tell you all of that. Happy to tell your neighbor all of that. Like, there's no, hey, this is the secret sauce. You can't find out. The more you are interested, the better we look, we think.
Exactly. A couple of more questions for you before I let you go. Again, we're talking about things that will help the middle class tremendously. And one of the things that I do see out there is a large percentage of people do not have fiduciary advisors, financial planners. They just don't have it. And what do you think is the number one thing that keeps people from knocking on your door and saying, hey, I need to get a plan together. I got a couple of $1 million. I feel like I'm just burning through my money. I really don't know what's going on. Is it shame, or like, what do you think that is that keeps people away?
Yeah, I think that's definitely part of it. I think it's a couple of things. I think it's shame and/or the opposite of that side, pride. Okay. Right? I can do it myself. And my analogy for that is, like, my undergrad degree is in engineering. So I used to work in a large rubber producing plant back in my 20s, a long time ago. Steel hat, steel toe shoes, the whole 9 yards. Why am I telling this? Well, I can fix my kitchen sink or my toilet when, like, I worked in the second largest rubber producing plant in the world. Like, I have the skill set to do all this stuff. But should I do my own plumbing? Now, like, I don't have the tools. I don't have the pipe in my garage. I got to go to Home Depot, get it cut right. Then I'm probably going to have to buy some extra stuff. I haven't done it for 15, 20, probably more like 30 years now. So, or I call the plumber, and he's got the equipment on his van. He knows exactly what to do because he's done this 100 times that day, probably. He might charge me a few extra bucks. That is maddening to me, But oh my God, I just saved myself half a day, if not a full day, trying to replace this pipe. So in some ways, I would look at us a little bit like the plumber. Like, I'm not saying I'm necessarily smarter than anybody else. If you wanted to devote your life and your career to managing money, I think the vast majority of people out there could do it. But I am here 24, well, not 24/7, but I'm here pretty much my full time doing this all the time, right? And we've done this over and over again and seen these patterns and series over and over again. So I think what it comes down to is people want to do it themselves, but don't want to pay the plumber to come in. They don't want to pay. They look at our fees like an expense. And one of the things we really try to do is say, you never pay for us. Like you never pay for us. When you sign on, you're on for 6 months free. Like, if I can tell you and show you that we add value, and that if I can't show you that we add value in 6 months, fire us. And we do not make a dime off of you. I don't get commissions from any sources or anything else. So I work for you for 6 months for free. And if you don't like us, get rid of us. Like, I want you to get rid of us. I don't want you to be unhappy. And have no hard feelings. Then after that, we have pay for performance pricing in some cases. So literally, if we don't outperform an index or a benchmark or something, you don't pay us. So if we're not paying for ourselves, we're not collecting any money. But even if somebody does an AUM type of strategy, I still want them to be of the mindset that, hey, you were very likely statistically going to underperform inflation, and we should be hitting your benchmark. So we're probably going to be outperforming you by 3, 4, 5%. We're adding value in a variety of other areas through planning and through additional financial services, and through, we might sell covered calls and puts and just do a bunch of things that you're just not going to have the time to do just to pay for our own fees. And if you don't feel like we are paying for ourselves, like, what I want you to feel like, if I left you as a client, like if I said, Mr. Client, I can't work with you anymore, that's going to be devastating to you. Not that you're going to be like, whew, I no longer have to pay his fees anymore. It's going to be like, oh my God, I can't lose this asset because he's part of my team and my family. And I really rely on him, and he does pay for himself through his own value. That's what I think people don't see. And I think in our industry, when I first got involved in this business, when I first got my Series 7, one of the first brokers said, did you pass? And I said, yes. And he said, you have a license to steal. And that was the mentality of these New York brokers at the time. And I think there's a lot of that headline risk in there where, like, these guys are just shysters and they're just people that are looking to just make money off of us.
Right.
And there are those people. But in my walk, the vast majority of the people that I have met in our industry are not like that. Now, maybe I don't think their process is as skilled as mine or as talented, but they're still probably doing better than what most people would be doing on their own.
Gotcha. I mean, you said something very, very, very important. I mean, I think you hit the nail right on the head. Many people probably don't hire someone, not only probably because they don't want to pay the fees, but maybe they've never really had anyone like you before. Maybe they've struck out so many times they don't want to try again.
Yeah.
And I've met people like that. And so, if we're talking to a client, a prospective client, and they're interviewing us and they've been burned so many times, and they're willing to give you like one more shot, and you probably know, like, this is it. Like, what would your message be to that person?
I had a call like that yesterday, as a matter of fact, and it was a similar thing. Like, he didn't know me from anybody. It wasn't even a referral. He came across me through the internet of some sort. And so he doesn't know me from anywhere. There's no trust at all, zero trust at all. And I went through saying, hey, look, we want to pay for ourselves. There'll be no fees. There's no ability for me to make any money unless I can add value in that 6 months. So I think just recognizing all of the risk he's taking. And I outwardly said that. I said, there's no reason for you to take all of the risk when you don't know me. And I'm sure you've been burned before. And there's no incentive for you to do this, but there is a benefit on the other side. And I need to prove this to you first. It's not on you to trust me. It's on me to prove it to you that I can be trusted. So we go through that philosophy and that shift of alignment, that shift of thinking from our end, from the advisor's end, like, oh, I need to bill you real fast. And I would say, I don't care about a quarter's worth of billing. I just don't care. My clients have been with me for decades. So if you come on board in a quarter and it's just not a good fit, and that's totally fine. And I don't want you to feel like, oh my God, I just got charged a fee and I feel like I got taken. Like I'm selling a particular product, a used car or, whatever, with a high commission. Like I'm not going to make a dime off of you until I prove to you that I'm worth the relationship to you. Gotcha. You shouldn't be taking any of the risk.
That's very important. And the last thing I want to ask you before we go today is, what motivates you to continue doing what you're doing and to continue fighting for your clients every single day? Because this is a battle. This is literally a battle. No one wakes up in the morning and they just stroll into the office and then they clock out and go home and play golf or whatever. Like this profession, you have to give it everything you got every day. So what keeps you motivated? What keeps you in the game? And I'll end with that.
Yeah, well, we can end and begin with that. So what's the title of your podcast?
Stop Doing What You Hate.
Exactly. And I have never hated this. And I have had jobs that I've hated. I have had jobs where I walked in and I was just like, oh, I can't believe I have to do this again. And, the alarm goes off and you're just dreading coming into work. I haven't had a day, and I've been doing this since the late 90s. I haven't had a day like that ever. So to me, it's not about motivating. Like you couldn't motivate me. You couldn't motivate anybody to just do this well day in and day out unless they absolutely loved it. So for you, stop doing what you hate. I stopped doing what I hated back in the late 90s, and I got on board doing this. And I will admit, when I first started in the business, where I was with a big broker, Lehman Brothers and Bear Stearns, I was pigeonholed into selling product, and I was not happy. But when I opened up my own RIA and was able to be a fiduciary and help people in a skill set that I think I'm particularly suited at, in a unique skill set in the business, I think I no longer had to be motivated. It's something I wanted to do on a daily basis. So when I go to cocktail parties or I'm talking on the holidays and you bring up the subject of finance, it's blah, 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 blah. My wife is like, shut up. Stop talking about finance. This is all you do. And I was like, well, I love what I do. I stopped doing what I hate a long time ago. So there's no motivation. It's that I'm working all the time, but never working at all.
Exactly. Well, thank you very much for being on today's show. Tell everyone where they can find you, and this information is going to be in the show notes, and so people can click on it and then look you up if the power notes that we're going to be posting out there on the internet, LinkedIn and stuff like that. Where can they find you?
Yeah, sure. So I'm on LinkedIn, Cruz AM. Cruz is KRUSE. My website, Cruz Asset Management. You can email us at info@Cruz Asset Management, and I have a YouTube channel where we post a lot of videos. We'll be doing our market outlook right after this show. So we'll post that on my YouTube channel, which is YouTube at Stu Cruz, STUKRUSE.
Awesome. I think if you and I were to sit down and have a drink, we probably wouldn't leave. They'd probably have to kick us out the bar or whatnot. You sound like a blast.
I love closing bars.
I'm sure your clients love you. And folks, if you're out there in Stewart's area in Chicago, check them out, please. And again, we want you to stop doing what you hate and do what you love. And with that being said, thank you very much, Stuart, and thank you for being on the show.
Thanks, Harold. Appreciate it.
This is thepodcastfactory.com.